Let's now turn to the advisory in the case for the post-tariff world of portfolio construction. Daniel Kelly is joining us from Viola Private Wealth. Daniel, good to see you again.
Good to see you again too.
Can we talk about post-tariff world? I mean, when are we at that point?
Yeah, well, I mean, it's going to be the ongoing world that we live in now, right? So I think the premise behind this is that, trade barriers have changed, globalisation has changed, and it is really a continuation of a trend of de-globalisation that peaked, after the GFC. And so, what we're considering at Viola is how we globally diversify portfolios, which is probably different now than maybe what it was the last 5 or 10 years. I think a lot of domestic investors, when they used to say we are globally diversified investors, it really means they were buying Australia and the US, right? And that was the right thing to do for the last decade. We would argue that the new trade regime means shorter and sharper economic cycles, structurally higher inflation, and a decoupling of economies from an interest rate and economics perspective and a GDP perspective as well. So we think this is a thesis to broaden the diversification that you have globally in your portfolio. It was under the previous regime, economic cycles were kind of dampened by the globalisation effect. And it was quite, a well-quoted saying that when the US sneezes, the world catches a cold. You can now globally diversify your portfolio and not harm alpha production, increase diversification, and really increase the Sharpe ratio of the portfolio, which is what we're trying to do.
So where are you looking for that diversification?
Europe, I think, for the first time in maybe the last decade and a half, is an attractive premise. They're spending a lot of fiscal GDP on growing their economy. The European market has done well year to date. We think that that's both on the listed and unlisted segments of the market. That's an attractive premise to globally diversify portfolios. But we also invest in certain geographies in Asia, but you have to be careful with Asia. And we only use active management in Asian economies just because of the different political regime that they're in.
So not emerging markets?
We do some emerging markets. Again, we'd only use active management for that. We believe that you need kind of nuanced and specific skill sets to extract outperformance out of those markets. It's often quoted that there's an emerging market to developed market valuation gap. I believe that that's there for a reason, and it will probably continue to stay there. And so we do some emerging markets, but not a huge extent.
Such as?
Again, it's mainly APAC, right?
Okay.
So not China, but we primarily diversify out of the US and Europe into APAC markets.
Why not China?
I think China is always interesting and it looks attractive. It's difficult to get over the difficulty of the political regime there, and there can be certain segments of the market there that are attractive, and then overnight it can change.
They can
and
just
so
pull the rug immediately. Yeah.
Yeah, I mean, we've seen them do that, right? And so we're looking for places to park money for 5 or 10 years, right? We're not a trading-based firm. We don't kind of go into and out of markets based on what we believe the next 3 or 6 months is going to look like. We're trying to look for structural thematics and tailwinds to get behind. And I continue to look at China. It's not off the board. It's just a bit difficult to justify a meaningful allocation there at the moment.
Daniel, we've seen central banks across the globe wrestling with the inflation dilemma at the moment, balanced with what they're seeing perhaps with weakness in jobs. With the risk that inflation is going to remain sticky, and we're seeing that here in Australia, we're seeing that potentially in the States as well. How do you mitigate against those risks?
I think building inflation protection into a portfolio now is something that groups like ours and investors have to consider that they haven't considered for the last 15, 20 years. And inflation was a theoretical concept that you'd learn about in textbooks, but there wasn't really a practical understanding of it. We've now gone through that educational journey, and we know how corrosive and erosive the effects of inflation are on purchasing power. So there are a few asset classes that protect you really well from that. I won't talk about gold. I'm sure gold's been talked about a lot here, and it's had an incredible run. We're just cautious anytime we see literally investors lining up in Martin Place around the block to buy an asset that really relies on greater fool theory to continue to go up. But we're a big user of infrastructure at the moment, mainly private infrastructure. And we just like the contractual-based cash flows those assets have. It's inherently structurally protected against inflation just by its very nature. The asset value itself rises with inflation, then usually these types of assets, ports, toll roads, harbours, things of this nature, have cash flows pegged to inflation, so it's an escalator effect. So we're a big user of private market infrastructure. And equities have continued to rally through inflationary regimes. I think the debate at the moment is, what the next 12 to 18 months looks like for the market. I think that equities do deserve a higher PE than what we have seen historically, just by the nature of the way that AI is embedding itself into every company, which is reducing costs and it's creating efficiency gains, which, if you were talking about that in any other way, should deserve a higher PE.
What role is fixed income playing in your asset mix?
We have dialed down fixed income. We're not the only group to do that. We looked at Harvard and Yale, for lessons on this, and Harvard in particular has dialed down fixed income materially in favour of investment grade private credit. Whenever we say private credit, and particularly in Australia, I know we're going through an ASIC review. I think that's a good thing. I think that is going to increase the reporting transparency in private credit, which is only a good thing. What the market needs to understand was with greater transparency and with more, I guess, efficient reporting mechanisms, we are going to erode some of the alpha that we have in our private credit market. That is where it comes from. That is the information asymmetry that creates the 150 odd basis points of alpha that our market has compared to overseas. But we focus on the very top of the capital stack, first loss protections, low LVRs, and then we also have globally diversified exposures to that. But we've trimmed fixed income down materially in favour of investment grade private credit.